welcome to a webinar by myself, Alex Waislitz, the chairman and founder of Thorney Opportunities, listed investment company, TOP, the symbol on the stock exchange. Thank you everyone for joining, and we are doing a series of webinars for TOP, which we've had before and will continue into 2021 in order to give you more updates, more timely updates and introductions to some of the representatives of the investee companies that we've chosen to put your money towards, and why you'll hear from them, why we're excited about what we're doing in that regard. If I take you back a few years, ladies and gentlemen, as to the origins of TOP, it was a mandate that we were seeking through the LIC to invest in value situations, whether they be from supporting turnaround stories or being a constructive catalyst for change with their existing business, driving discussion about how to improve shareholder returns, or supporting growth through organic situations or from acquisitions themselves. Whichever it was situations where we believe were undervalued by the market, and there was opportunity for us to get a position as an equity investor and to ride the upside as that turnaround or that value catalyst came to pass. So it's been a successful strategy for myself and the team through the private company, and it's also been successful in the public arena. So we thank you for joining today, and we're going to talk you through a couple of situations around. Ladies and gentlemen, this approach to value investing, which we've discussed as being our main objective, it was not popular in the last year or two. And the reason for that in particular was because of the focus by investors, institutional and retail and paralleled around the world, was really on technology stocks, the fast moving ones, the opportunistic ones, the disruptor ones. And particularly through COVID, that was also very sensitively responded by the market when it went down, but also bounced back quite strongly as people took advantage of the companies that were performing as a result of the changing patterns that took place through COVID. But we did say, and we've been reminding the market, that there is a time and place where value investing and underappreciated situations, cheap situations will raise their head again and ultimately be sought after in investors. And through the post-COVID hit that took place earlier in the year, in March and April, the comeback from the market has been very strong, not only in tech, but we're starting to see that rotation through to cyclicals and value situations. And that indeed is being reflected also in M&A activity, where corporates are trying to buy public corporates or private equity firms, companies on the stock exchange that are really, as we say, undervalued. We had such a situation with one of TOP's companies called OneView, and we lobbied quite hard to increase the offer that was achieved. In fact, we would have preferred if it stayed public and continued its growth, but nonetheless, we achieved a better outcome for all shareholders, and that situation was exited through the bid by way of a scheme of arrangement. So we had a situation where the market is now turning to value and appreciating a lot more. And as a result of that, and as a result of the achievement of some of the companies we've invested in, we're having a very strong period during this financial year. So as we put out our NTA this morning at about 70.5 cents per share, that's after tax and after fees. And that's an increase of some 15.5% since the start of this financial year. So we're very happy that we've had such a strong start to the year. We're very happy that our approach has been validated. And whilst we were disappointed with last year, we can see that turnaround in our situation coming straight through to the NTA increase. So again, we've justified, we think, the mandate that we've pursued from you, ladies and gentlemen, and shareholders. And we're very keen to continue that journey. We've said in some of our letters that not only we are identifying new opportunities, we're also pursuing some opportunities in the unlisted sector based on our experience of the recent ACM deal, where Thorney Opportunities has a 25% shareholding in those assets that were bought out of Fairfax. And despite having to deal with the bushfires, floods, and COVID, that business is progressing along quite nicely as we transition it from a company with not only publishing but printing assets to more publishing focused and a digital focus as well. And we'll hear more about that as we go forward into 2021. So again, we're thrilled with our start of this year, and with our confidence with the portfolio positions, despite the market not appreciating some of them last year, we have still maintained a approach to paying out dividends as we could. And indeed, we paid out a record level of dividends during the year for the financial year 20 of 2 cents a share, fully franked. So today we're pretty excited with some guest speakers that we have. And we have 2 of them today. And the first one is David Maxwell, who's the CEO of Cooper Energy. And I won't read along the resume for David, but suffice to say that he's had 30 years experience in senior executive roles in the oil and gas industry for not only Cooper Energy, but BG Group, Woodside Petroleum, and Santos. And during that time, he's been involved in delivering major projects, acquisitions, negotiating large offtake agreements. He's been recognized on industry association boards and as an advisory capacity to the government at various times. And he is a man in charge of Cooper Energy. Cooper is an ASX 200 oil and gas company. It generates most of its revenue from the supply of gas to Southeast Australia and is Australia's first oil and gas producer, I believe, to achieve net zero carbon emissions. The company operates offshore gas facilities in the Otway and Gippsland basins in Victoria, including the Sole gas field, which is the first offshore gas field development in the region for several years. He'll tell us about Sole in a minute, and he has a number of other opportunities, expansion ones that will drive the company, we believe, forward in the 2020s, 21, 22, 23, and beyond. So without further ado, I'll introduce David Maxwell, if you're there, David. Trying to find David. Is David there?
I'm here. I can hear you, Alex.
There you go. There you go, David. I can't see you, but I can hear you. Whereabouts are you at the moment?
Hang on. Let me put the camera on. Here we go. I'm in Perth. I've been isolating in Perth since March, and other than one trip which I absolutely had to do to Sydney, we've been operating our oil and gas production, exploration, development remotely.
Oh, well, that's great. Thanks again for joining us. We appreciate it. We know you've got a lot going on at the moment. So we've got about 15 minutes to talk to the people who are on the line. And I suppose if you can give us the brief outlook of what it is that Cooper does. And then I guess the focus is on the Sole gas plant and some of the hiccups you've had there, but the excitement you feel going forward.
Yeah. I think your introduction was a very good one. I won't repeat any of that. But the strategy that we've pursued is that we know that there's going to be a shortfall in gas supply in Eastern Australia, and particularly Southeast Australia, Victoria, New South Wales, South Australia. So 6-7 years ago, we identified the best resources to supply into that shortfall. The best resources being those that are the lowest cost and therefore the greatest margin. And we've now built, as you said, a position where we've got gas supply in the offshore Otway around Port Campbell and gas supply in the offshore Gippsland around Orbost. Our current gas production is predominantly out of the Otway, around about 16, 17 terajoules a day. The Sole project is in the middle of commissioning, and you're right, we've had some challenges with that over the last 9-12 months. We're the operator of the offshore, which is all controlled remotely. The gas plant itself is owned and operated by APA, and APA have had some challenges with that gas plant, where they've just had a shutdown. That came back from that shutdown last weekend, and within a week, we expect that plant to be back up and running, and production out of that plant through December around about 35 terajoules a day, and then January it goes to 54. So you're going from 16 odd terajoules a day in the portfolio to 70 terajoules a day, a circa 300% increase in the next month. And that translates into a more than 300% increase in revenue and net cash flow. In some respects, 2020 has been a frustrating year for a range of reasons. But for us, the deferment, the issues that APA have had with the gas plant have been the most frustrating. But the nice part about it, I suppose, is, if there is a nice part to it, is that it's all deferred, it's not lost. And the gas market, the supply situation is only going to get tighter.
Yes, it seems, David, I guess your share price is not far from being half of what it was perhaps 12 months or so ago. And it seems to me that that's been the concerns about Soul, as you talked about. But we think that we're on top of that, and we look to ramping up the production levels, as you say, over the next month and 2 months and 3 months. The other thing that seems to be a bit confusing, and I get questions which I can't answer, but I'll direct them to you, is really about the government's approach to the gas market in total, and the sort of market approach, the confusion about overseas pricing and domestic pricing. Can you give us a little bit of insight about that? Because we think you're terrifically placed to take advantage of what's going on, which is that sort of tight supply and shortage.
Yeah.
I suppose, is that true? And what will market forces do to perhaps challenge your superior position there?
Yeah. First of all, the supply-demand situation. At the moment, through this year, supply in Southeast Australia, predominantly out of the Gippsland Basin, BHP and SA, has been pretty much equal to demand. And then we've had the coal seam gas projects in Queensland have been experiencing some problems, and that the LNG price, the spot LNG price, has been very low. So in order for them to maintain production and keep up supply to the domestic market, they've been putting spot gas into the market at a very low price. So we've seen spot prices in Victoria, New South Wales through the period February, March, April, May, June, $4, $4.50. That price is not sustainable for new supply. We have seen spot LNG prices increase significantly in the last 2 or 3 months. I mean, I just looked earlier today, $6.70 in Victoria, $7.30 in Sydney. So, that's coming up to a double of the price in the last 3 months. And that's all off the back of higher spot LNG prices. So what we've seen in the last 12 months is a short-term period. If you walk forward 2 years, 3 years, we got supply shortfall in Southeast Australia of about 130, 140 terajoules in 2 years' time and 3 years' time. That's the equivalent to 4 or 5 Soul projects. The LNG market is expected to be tight in 2 or 3 years' time as well, because people haven't been investing in the last couple. So that gets back to where we think prices will settle, in that 8 to 10 range. And that range is also the range that's needed to support new supply. I mean, just simple economics. The break price is going to be the price that attracts new supply.
Well, certainly, if the price does get to that 8 or 10 range, you'll be generating a lot of cash flow out of your operation. But I think maybe to the listeners who may or may not be familiar with the story, and this is one of the reasons we're highlighting it, is the scale of achievement of getting the Soul plant up. Maybe you can comment on that, because it's such a difficult permitting process and not easy for others to do.
No, you're right. Well, the Soul project itself was 100. I think I'm right in saying 127 regulatory approvals. And that's not a letter with a reply. That's a report and questions and answers. It was a project which was three years for development. You have to be approved by the regulator, NOPSEMA. You have to have qualified people, and you have to have a balance sheet. And that's the reason that, frankly, that we partnered with APA around Sole. In our business, in the offshore business in Australia, and the Australian companies, if you went through them, Woodside, Santos, Beach, and then it's Cooper Energy. And then it tails off, and there's a number of other companies which are involved in the onshore, which is smaller scale. But it's a thin field. And the way that we've resourced ourselves and the way we've gone about it, some people call us a little big company, other people call us a big little company. And what they mean by that is the experience that we've got in the company has all come from much larger companies, international experience, in many respects, people that want to come home and work for something where they can make a difference, where they can see the experience that they've gained, the skills that they've got from much bigger operations can be applied in a very one team way to the opportunities in Australia. So we don't have a lot of competition for what we're doing at the moment, and there's a market crying out for the product, and the price is going to be robust in terms of high.
So you have no one's ever called you shy of ambition and of growing a great company, and you've done a lot in a relatively short period of time, and you've got an impressive group of executives and team alongside you. So apart from Sole, which we hope will be, as you say, getting on track into 21, you've got a number of other potential growth initiatives. Do you want to touch on them, David, if you would?
Yeah.
And then maybe a comment about this renewed hype or global hype on renewables that's going on from all sources, hydrogen included. What does that mean, and what's the challenge to Cooper from that? But let's touch upon your potential growth and expansion projects as well.
Yeah. Okay. Well, the existing projects with Sole takes us to 70. With what we know we can do, there's a bit more work to get extra capacity through that plant, which takes us up towards 100. Then we've got two projects to follow behind that. We've got what we call OP3D, which is Otway Phase 3 development. That's the development of the Henry and Annie field. That's another 30-odd terajoules a day for ourselves. And then we've got Manta, which is come in behind that in the Gippsland, which is 50 terajoules. So we're not that within the next 3 to 4 years. We're growing our production in excess of 300% in the next couple of months, and then we double that in the next three to 4 years just on existing projects. So, and that similar cash flow and revenue as well. Then, so clearly, so what comes after that? We're looking at exploration opportunities in both the Gippsland and the Otway, where we've got plant and plant capacity. So that's been very much our core, 2 plants, acreage around the plants, build the cash flow, long-term stable cash flow, 8, 9, 10 years, and then go to the next level. Your question around renewables and all of that, every forecast that I've seen, International Energy Agency, Shell, BP, everybody says that gas grows with renewables. Renewables need gas. When the sun isn't shining and the wind's not blowing, it's gas that is there to keep the electricity flowing. And so the role of gas for the next 10, 20 years it's a healthy industry. It's a growth industry. Unfortunately, it's a fossil fuel. And that's where some of the tension has come from. We've got our way around that by saying, well, it's a fossil fuel, but we'll be net zero. And that's something that we developed 9 months ago. We held back announcing it until October because we wanted to announce it and say that we are, not we're gonna. And that's what we did in October. In terms of renewables themselves, I think the core skills in renewables are quite different to the core, and risk management is quite different to the risk management in oil and gas. But one of the big things we'll be focusing on in the next few years is working with our customers, providing them with green gas and looking at opportunities where we can combine with renewable opportunities where 1 + 1 then equals more than 2. That's the approach that we're taking. We've seen ourselves in a situation with not a lot of competition, growing demand, and how do we create that advantage where we're locking ourselves in with industrial customers who have a need for clean energy and definitely need gas.
Yeah. So thanks so much, David. Ladies and gentlemen, you might ask why have we got Cooper Energy in Thorney Opportunities? We don't often have resource companies there historically, but we do. I do own Thorney. I do own in the private Thorney Group a fair holding in Cooper, and it entered into Thorney Opportunities because, as we said in the introduction, we believe David, with all his team, has got a company here that's on the cusp of some significant uplift in value, and the market has knocked back the price because they've had some delays, as David hinted on Sol, and some overall, commentary about the oil and gas sector, where obviously oil prices have been down over the last period. But we believe in David and his team. They're committed. They've got a lot of equity themselves in the project, and we think he'll come through, and you'll see this company has merged on, as I said, it's already on the ASX 200, and I think it's going to go just in scale. So thanks very much, David, and good luck over these next few months as you hopefully tackle these problems you've alluded to, and we see the ramp up happening. You seem to have ability to fund projects as you need to because of the work you do behind, and you seem to be able to keep your customers, those industrial customers, on board, and I think they're clamoring for more of your product, actually. So because they all need to secure supply, and renewables may be coming, but there's still a long way to go to satisfy the demand that we need. So thanks very much, David, for being part of it.
I saw there was a question there about renewables. We put out an investor pack earlier this week. The answers on how we net zero was in that pack. So the person that asked the question, have a look at the investor pack on the website. Many thanks. Thanks, Alex.
Thanks again, David. Look forward to seeing you soon.
Good. Tess, all the best. Stay safe.
And ladies and gentlemen, we're going to continue with, I suppose, the theme relating to oil and gas and services that are needed into that sector. And we have with us today again another David Ross, who's the CEO of MMA Offshore Limited. David was appointed as Managing Director of the company in January of 2020. He has spent 30-odd years in the maritime industry, starting as a seagoing marine engineer, and he's been involved in MMA Offshore for quite a while himself. He's worked at BHP Transport. He's worked for BHP in the Netherlands as well. And so a wealth of experience, and he moved to Singapore to take over the running of this company as it is international in nature. And MMA Marine specializes in providing high specification vessels and a comprehensive suite of marine and subsea services to the offshore energy sector and the wider maritime industry. The company has a combination of over 30 high-quality vessels. They're strategically located onshore facilities, specialized subsea services as well, in-house technical marine expertise, which enables it to partner with clients to deliver innovative, fit-for-purpose marine solutions. And David, are you there with us?
I am, Alex. How are we all?
Hi there, David. Are you in Singapore at the moment?
No, I'm down in Perth, actually. I came down about a month ago, did my quarantine, and I've been released into the community. So.
All right. Well, you've had an interesting period of late, and with an equity raising that just happened. But just before we talk about that, maybe just I've just alluded briefly to the company, but maybe you want to just expand on that, or just talk about what the how you've survived when many haven't in tumultuous last few years.
Yeah, no, thanks very much. It's a great introduction. We are a marine service company. We do work predominantly in the energy markets, but we do work elsewhere as well. We operate from Australasia, Southeast Asia, through the Middle East, into East and West Africa. We actually have a vessel up in the North Sea at the moment as well. So we are reasonably well spread out. You're absolutely right. 30 high specification vessels. We actually have 32 in the fleet at the moment, operating around the globe. They are working from service supply to oil and gas facilities, to renewables in Taiwan, and up in the European market across both sectors. So we are reasonably widespread with the fleet. The subsea part of the business, or our service line in marine work, we picked up the Neptune business about 12 months ago, or the subs of the Neptune entity. That gave us a different feel and a different mix. So we have a far more service orientated aspect to the business now, which is actually working really well. We leverage the vessels and the subsea services together and get a better margin out of the combined units. We also, the third division of the organisation is our project logistics business, which we started around 12 months ago, and it really focuses around asset light, using our skills and our procedures and processes that we've learned over the years to work into large scale gas projects and renewable projects on a logistics basis. So moving equipment in and out. So the three divisions complement each other. They work independently, but they also work together. So we have had a reasonably torrid time in the industry, but the business has always had quite strong production support contracts in it, which carry us through these times when we get dips in the market. And we were coming out of that dip pre-COVID, but unfortunately we've just stalled a little bit in that recovery at the moment.
Yeah. So you've diversified the nature of the business quite a bit with Neptune and some of the other initiatives. So you're not fully reliant on the oil sector as you were in the past. And generally around the world, we've seen a lot of capacity go out of the market, perhaps never to return. And so we're starting to see the charter rates and tighten up a little bit. And we believe that that will continue and will be looking quite firm going forward into 21 and certainly into 22. Is that sort of consistent with the views of the company?
I think that from a supply side and the vessel side of the business, from a supply point of view, we've seen the downturn since 2014, 2015, and a lot of assets now have left the market. They've either been scrapped or they've been left in such a poor state of repair. It's really difficult to see them to come back to challenge our fleet. We've been fortunate that we've been able to keep the fleet well maintained, operating and working for pretty good clients through that period. So we do think that from a supply point of view, although there is always a threat of supply in the market, that it's getting better balance as we come out of this COVID kind of restructure to the industry. So you're right, Alex. We haven't seen really any strong rate recovery yet, and COVID did take or temper the recovery that we saw in late 19. But we do expect over the coming years that then when the supply kind of tightens up, that we should see some rate recovery in the market.
Right, and you've had arguably a lot of debt on the balance sheet over the last few years, which came historically before your time as the CEO. You've whittled that away with some asset sales and some other initiatives, but eventually and recently you raised some more equity to support the balance sheet. I suppose shareholders have asked me, and they've probably asked you, is that the last we're likely to see of equity raisings? Are the banks very supportive now with what you've done? Have you got some more assets that you might be able to sell to keep improving the strength of the balance sheet as the revenue side starts growing again?
Yeah, absolutely right. We did do a capital raise, which the retail completed last week. So we announced that this morning, which was pretty successfully taken up, which we were really pleased with. The debt metrics of the business coming into COVID were quite challenging. The original plan was to try and work through a market recovery. once we got COVID on us and a cloud over the industry and a slowdown again, we thought the right direction for the balance sheet was to raise some equity. So we raised $80 million, fully underwritten, as you mentioned. Got that away. The great thing about our banking group, we managed to negotiate for 3 of the banks to leave the syndicate. That process took quite some time. We've been negotiating with them since May, but we had a banking syndicate of 7. We're now down to 4. The 3 that left took a discount to the debt, or concession of the debt, of around $15 million. So that created value for the existing equity, which was really pleasing. And we brought the debt down by around $93 million in total. So we're now sitting at $173 million gross debt. If you look at our cash in September that we reported during the raising, around $90 million, our net debt's sort of $86 million on $415 million worth of assets. So the balance sheet's much more robust to work its way through COVID and the likes. So we're really pleased where that is. You mentioned we sold some assets previously. We had pre-COVID targeted 12 assets in the fleet to sell. They're the smaller, more commoditized vessels where we really don't get good returns on them because we don't add enough service to them. And I mentioned earlier that the combination of our subsea service business and our vessels combined together gives us a better leverage in the market. The vessels that we're looking to sell, 12 of them aren't in that space, so they don't complement the strategy going forward, and we're better off exiting those vessels. So there's $42 million of assets held for sale on the balance sheet. We impaired them, extremely strongly at the end of the financial year to put us in a position that we could sell them in this market. And when we take those $40 million off, suddenly our leverage comes down quite substantially. So we'll continue to delever the balance sheet with some asset sales, and then we'll grow the earnings back through it.
Right, and that will leave you with I think one of the more modern fleets that are out there in the market. Is that correct?
Yeah, absolutely. So the fleet's really quite, from an age point of view and a specification point of view, is sitting up there amongst the leaders in the industry, certainly in this region. The average age of the fleet around 7. If you look at the industry as a whole, there hasn't been any really new vessels built in the last 6 or 7 years. So to have an average age of 7 means you're holding one of the youngest fleets in the world. But more importantly, it's fit for purpose from a specification point of view. It's what we need for the future, and it's really quite an efficient fleet to carry now.
Right. So we at TOP, like many other shareholders, have been, I guess, through a torrid time with MMA, and we were supported the capital raising and averaged down our price. We're still underwater, but we're not that far away. We remain enthusiastic for the outlook going forward under your leadership in 21 and 22, and looking to recover as I guess people lose concern about the debt overhang that they previously had. We start to understand the streamlining of fleets that are out there, and particularly your own, and enables you to be more nimble. Why should we remain confident and looking forward? And from the capital raising price, it's obviously bounced off of there, but we're looking for confidence, I suppose, for our holding, and to let our shareholders know why we continue to support and participate in the capital raising. We believe in the outlook, and we believe it looks pretty compelling if we're patient enough. Looking out over the next 1 to 3 years, we think MMA is going to find itself in a pretty strong position in its part of the market. So can you give us a bit of a sort of talk about the future and the outlook, that where you're taking the company forward to?
Yeah, I think there's a couple of elements to that, Alex. The first one is absolutely right. The debt overhang on the business was holding us back from an equity point of view. I think people looked at us and thought that the debt stack was too great to work over. So we took the view of removing some of that now with the raising. So that's taken some of the pressure off the equity. If you look at the strategy of the organisation, 18 months ago, we recut the strategy and said, there's no need for this organisation to just use its marine skills in just oil and gas markets. And there's a very, very good opportunity for us to broaden where we actually use our skills. And we've been taking that on over the last sort of 12 or 18 months. And we've recently had 3 vessels up in Taiwan working in the renewables industry. That's been a successful campaign this year. We're setting an entity up in Taiwan, and we'll look to that market for some stronger growth in the near future. We've also done some work for the Australian government with hydrographic survey work with the HIPS program out of Broome. So we're starting to diversify our earnings, which is really positive for us. The other element is that the oil and gas industry, and particularly the gas industry, we still see as a really viable place for us to ply our trade, and where the vessels are well suited to. But if we can take the basis of that business and nurture that, and then build out into renewables and other sectors in the marine industry, we think we can have a much broader revenue base for the organisation into the future. So we're quite positive now. We've got our debt in a better place. We look to the renewables market to give us another whole sector to work in, and then we'll work through the recovery of the gas market as that comes back to us as well over the next 2 to 3 years.
Yeah. Okay. That I think is, well, that's the reason we're there, and we believe that there's plenty of upside. I mean, this company did have glory days in the past, and as you said, it's gone through some difficult, but I believe you're leading them now through to the right path going forward. I mean, you're based in Singapore normally. That's one of the hubs of the sector. Any overall comments about the sector and how it's how you find other companies have responded to the challenges?
I think if you look at the sector in general, being in Asia is important. It's a little tricky at the moment with travel restrictions and the likes, but it's still important for us to have a solid hub in Asia. So about half our team operate out of Asia, and then we have an office in Aberdeen and one down here in Perth. So we are spread, which is important because we get a better view across the whole market. From a competitor point of view, some of the bigger Norwegian operators are still sitting in a kind of frozen state, and certainly a lot of the Asian operators are still in this frozen state of limited cash to support their business. They're hand to mouth on a lot of maintenance and the like, so their assets, in our view, are deteriorating, and it makes it harder for them to compete against us with the good clients. I think from a project point of view, if you look to where we operate predominantly, East Africa is really interesting for us with the Mozambique gas facility under development with Total. We've got 5 vessels over there at the moment. They're not our vessels. The project group have chartered them in, and we're just margining those and using our skills in that space. So that's a good growth area for us. The Taiwanese offshore renewable market is an enormous, and we're really quite excited to be part of that and look to learn more and get more skills out of Taiwan to take to Vietnam and South Korea and the likes before we see some offshore development in offshore wind in Australia, we hope in the coming years as well. So that space is really exciting for us in Asia. And then we look down to Australia. I still believe that there's some strong gas projects that will get underway in the next 12 to 18 months. And we look to Scarborough and Barossa and the likes, which are really good gas projects for Santos and Woodside.
Yeah. Okay. Well, thanks, David. I guess, and you can certainly talk to David from Cooper about some of the projects onshore in Australia. I'm sure you can have some interesting conversations. But ladies and gentlemen, we think that the company was worth supporting through the capitalisation. We've averaged our price down. It did look that for a while they were going to be able to hold their debt levels, but I think the circumstances of COVID and just other pressures, I think the companies did the right thing by reducing their debt level and streamlining their banking group. They're now in a much stronger position. When you look at the share price relative to net assets and what's happening in the sector to their competitors and the potential outlook going forward, we remain pretty enthusiastic to be a holder here and have added to our position. So thanks again, David, for joining us, and keep healthy, keep safe, and hopefully we'll get to meet you in Singapore before too long, maybe next year.
Yeah, thanks very much, Alec. Most welcome.
Okay, thank you. Thank you again, David. So, ladies and gentlemen, we've just got a few more minutes to talk about, and I'll just make some more general comments about Thorney Opportunities, where we are. Just recapping, you would have seen some of the slides as you're waiting to join the call. We have maintained some consistent holdings over the years, and they've delivered for us in terms of their profitable growth, in terms of their share price, where many of them who have been knocked during the COVID hit on the market, but have come back strongly and have produced dividends for us. So I'm talking about companies like Money3 and ServiceStream. They've both had interesting. Money3's announced positive changes to their core funding facilities and highly active still, despite concerns that initially were there around COVID. They've proven not to be the case, and the company's in very strong shape with analysts broadly upgrading their earnings for them. ServiceStream has had substantial contract renewals of late and have rebounded in their share price. AMA, which was knocked about obviously with COVID and the closure of the borders and people not available to drive more than a few kilometres, the traffic wasn't on the road, but clearly that's opening up again. And the previously mooted synergies from being able to have some of the cost savings across the country will now be able to be achieved. And I think in addition, they sold a significant division for $70-odd million, which completely improves their balance sheet as well and strengthens their position. And they're very focused on their core auto smash repair business. And I think we'll have room to consolidate further their leadership in the country in that stake. So we like that. We talked about some turnaround companies, and as we said, we're keen on those. We like those situations. So we've been a backer of the turnaround that's going on at Retail Food Group, and also led by one of our directors, Dr. Gary Weiss in Ardent, through COVID and through other challenges. Both of them seem to be now starting to perform well and be really well positioned for as people's movements are more allowed and permitted. We'll see that happening further. We remain with the theme of some mining services and some recapitalizations and turnaround issues there on some challenges. So Decmil and Southern Cross, and we've touched upon Mermaid with its recapitalization. We have a few newer, smaller positions also in the portfolio, which we'll talk about when it's appropriate. And I just want to finish here on turning to the private shareholding we've got in Australia Community Media. We've worked very hard to, as I said at the beginning, overcome some of the challenges. I'm happy to report that our digital audience is growing quite fast. We're actually a potential beneficiary of the thematic that's happened from COVID, which is people moving to regional and rural areas. And we believe that will force the advertisers to spend more money on that part of the market in Australia. After all, we have a reach of some, I think it's 8.5 million Australians through our publication. So we're looking forward to seeing if that comes through. And we have a lot of initiatives going on there as well that will keep you informed. But trying to keep to the schedule at 45 minutes, we'll just finish off by saying that we feel we've again had a very strong period. We're happy with a lot of the companies in the portfolio. We've had a liberation of cash through the takeover of OneView, partly redeployed into Mermaid Marine. We like what is happening in terms of the rotation back to value and in terms of a market thematic. We believe that will continue strongly into 21, and we think we're well positioned to take advantage of that. We're working very hard, the whole team, on your behalf, and we will continue to do so. And I wanted to wish you all a happy, safe Christmas, and look forward to talking again with a webinar next year where we can inform you on some of our newer initiatives as well. So thank you very much, everyone, for joining. Thanks for being part of it, and we'll see you again next year. All the best.